The stronghold has been breached. For a span of 5 years, the global consortium of financial institutions drew a definitive boundary at the $50 mark. They fortified this position through the issuance of paper agreements, the implementation of margin escalations, and the orchestration of media silences. However, merely 3 days ago, on the 6th day of December in the year 2025, that demarcation did not merely falter, it dissolved entirely. The price of silver surged past $59. And as I address you at this very moment, on Tuesday, the 9th of December, we are witnessing an event that has not occurred in 45 years. We are observing genuine price discovery. The established financial news outlets are displaying bewilderment. They are disseminating the narrative that this represents a speculative overreach. They are advising you to secure your gains, citing an overbought relative strength index. They are proclaiming that $59 is an exorbitant valuation. They are mistaken. $59 is not the apex. It is the foundation. This is because the underlying dynamics, obscured from public view and deliberately concealed by entities like JP Morgan, involved more than mere paper manipulation in keeping silver undervalued. It involved a physical reservoir, an accumulated stock of readily available inventory that the world has been depleting since the year 2021. I have meticulously analyzed the figures. I have tracked the supply shortfalls as reported by the Silver Institute. I have monitored the withdrawals from the London Bullion Market Association's vaults and the record-breaking inflows into India. The arithmetic is stark and alarming. Since 2021, the global consumption of silver has exceeded its mined production by more than 1.1 billion ounces. Let that magnitude resonate. 1.1 billion. This quantity is equivalent to the entire annual output of every silver mine in Mexico, Peru, and China combined, rendered moot for a full year. It has vanished. It has been incorporated into solar panels, relegated to landfill sites, and secured within private repositories in Mumbai. This buffer of 1.1 billion ounces was precisely what enabled the banking syndicate to artificially suppress the price. It served as their contingency fund to bridge supply gaps. However, as of this month, that contingency fund has been depleted. Over the ensuing 20 minutes, I will illuminate the phenomenon of the vacuum effect. I will demonstrate why there exists no significant technical impediment between $59 and $100. I will conclusively prove that the solar energy imperative has rendered demand completely inflexible, and I will elucidate the reasons behind the Indian investment entity's strategic acquisition at the market's nada, while the Western financial community was divesting at its peak. The supply deficit is undeniable. The storage facilities are bereft of metal, and the economic void is now palpable. This is the chronicle of the 1.1 billion ounces that have disappeared, and the rationale behind their impending influence on the dollar's trajectory. Let us commence with the quantitative analysis. For to comprehend our trajectory toward $100 and beyond, one must first grasp the depth of the chasm we have collectively created. Throughout the majority of the decade of the 2000s, the silver market experienced a period of surplus. Mining operations extracted the metal, industries utilized it, and there was typically a residual quantity remaining. This surplus silver was stored in vaults. It was held in London. It was deposited in New York. These stockpiles maintained price stability, resulting in unremarkable valuations. Then arrived 2021, the year that marked a global paradigm shift. In 2021, the deficit commenced on a modest scale, but by 2022 it had escalated dramatically. The Silver Institute reported a shortfall of 237.7 million ounces. In 2023, an additional 140 million ounces were deficit. In 2024, the deficit expanded once more to 215.3 million ounces. And now, as we conclude the financial year of 2025, preliminary forecasts indicate that we have consumed an additional 200 million ounces. Aggregate these figures. Since the inception of this decade, we have incurred a cumulative structural deficit approaching 800 million ounces. But this figure represents only the officially reported deficit. It does not encompass the disinvestment trend, wherein silver has been withdrawn from exchange-traded funds and transferred to private holdings. When one factors in the depletion of the London Bullion Market Association's vaults, which decreased by 30% from their peak in 2021, and incorporates the surge in retail accumulation, the actual deficit surpasses 1.1 billion ounces. Contemplate the implications of this statistic. The entirety of the global silver mining industry produces approximately 830 million ounces annually. This signifies that for the past 5 years, our annual deficit has exceeded the total global production for a single year. From whence did this supplemental silver originate? It emanated from what I term ghost inventory. It was drawn from the billions of ounces held in London's vaults, remnants of stockpiles from the 1990s and strategic government reserves. We have been drawing down our savings account to cover our daily expenditures, and the banking cartel found this highly advantageous. As long as there was this phantom silver to be introduced into the market, they could point to the vaults and assert, "Observe, ample metal available, no scarcity here." However, mathematical principles are immutable. A deficit cannot persist indefinitely. Eventually, the savings account will be depleted. This is precisely what transpired this week. This is the catalyst for the breach of the $59 threshold. The phantom silver has been exhausted. The available float on the London Bullion Market Association, representing the metal actually accessible for lending, is effectively zero. The registered inventory on futures exchanges has dwindled to negligible amounts. Consequently, every newly manufactured solar panel, every advanced cruise missile, every new iPhone must now be constructed utilizing silver that was extracted only recently. There is no buffer. There is no emergency reserve. And when you encounter a market characterized by inelastic demand, where consumption is necessitated irrespective of price, and when the supply buffer is removed, price adjustments are not gradual. They become parabolic. The 1.1 billion ounces did not simply evaporate, they served as the anchor tethering the balloon. And that tether has now snapped. However, the skeptics contend if silver prices ascend to $60 or $80, demand will undoubtedly plummet. Solar manufacturers will transition to copper. They will reduce their silver consumption. This represents the most significant deception being propagated on Wall Street at this juncture, and I shall dismantle it with a single acronym: TOPCon. For many years, the solar sector relied on a technology known as PERC. It offered adequate efficiency and required approximately 10 milligrams of silver per watt. However, PERC reached a developmental plateau. Further efficiency gains became elusive. In the energy sector, efficiency is paramount. Therefore, the industry underwent a strategic pivot. In the years 2023 and 2024, the entire global manufacturing infrastructure transitioned to TOPCon and HJT solar cell technologies. Herein lies the critical issue. TOPCon does not utilize 10 milligrams of silver. It requires 13 milligrams. HJT technology demands 22 milligrams. We are observing an escalation in silver consumption, not a reduction. Why can they not substitute copper? They have attempted this. Oh, how they have endeavored. Copper oxidizes. It corrodes. It significantly diminishes the operational lifespan of solar panels. When one is marketing a solar farm backed by a 25-year warranty, the use of a metal that deteriorates within 5 years is untenable. Silver is indispensable, and here are the economic realities of the solar acceleration. Let us assume the manufacturing cost of a solar panel is $200. With silver priced at $25 per ounce, the silver content within that panel contributes approximately $15 to the cost. This constitutes 7.5% of the total expense. Now, consider the present situation. With silver trading at $59, the silver component now incurs an approximate cost of $35. Does the manufacturer cease production of the panel? No. Does the government retract its solar energy mandates? No. They simply elevate the price of the panel from $200 to $220. The demand for silver in the solar industry is inelastic. A 100% increase in the price of silver leads to a mere 10% rise in the cost of the final product. This grants silver pricing leverage that few other commodities possess. If crude oil prices double, consumers reduce their driving. This is demand destruction. If silver prices double, entities like Samsung and First Solar continue their procurement unabated. They have no alternative. And recall the deficit we discussed. In 2023, solar energy accounted for the consumption of 193 million ounces of silver. In 2024, this figure exceeded 230 million ounces. Projections from the University of New South Wales suggest that by the year 2030, solar energy could be responsible for consuming between 85% and 98% of the world's total silver reserves. Not annual production, but the silver still embedded within the Earth's crust. We are engaging in strip mining of the planet to achieve our green energy objectives, and the easily accessible silver is no longer available. Therefore, when you observe silver priced at $59, do not perceive it as expensive. Recognize it as essential. Industrial purchasers are not scrutinizing price charts. They are consulting their production schedules, and they are in a state of considerable apprehension. They are the active buyers at this moment. They are not engaging in transactions for paper contracts on futures exchanges. They are directly contacting refineries and stating, "We will acquire your entire output. Name your price." This is the rationale behind the spot price leading the futures price. The physical market is issuing a clear and urgent signal. To ascertain who has prevailed in this economic contest, do not direct your attention to Wall Street. Observe India. While Western investors were offloading their silver exchange-traded funds during 2023 and early 2024, India was undertaking an action of unprecedented scale. They were systematically emptying the Western holdings. Consider February of 2024, a date that will be etched in history as the harbinger of the decline of the London vaults. In that singular month, India imported 2,295 metric tons of silver. To provide you with a frame of reference, 2,295 tons approximates to 73 million ounces. The United States Mint produces roughly 20 million silver eagles annually. In a period of 28 days, India procured an equivalent of 3.5 years of the entire U.S. Mint's silver eagle production. The question arises, why? Because the influential Indian investors foresaw the impending deficit. They recognized the 1.1 billion ounce gap before the rest of the world did. They understood that the solar manufacturing facilities being established in Gujarat would necessitate substantial quantities of silver paste. They were aware that the Gift City Exchange was emerging as a direct competitor to the Western financial centers. Consequently, they purchased at the market's lowest point. They acquired silver when it was priced at $22, and again when it was $24. They depleted the London vaults while the London Bullion Market Association was notably complacent. And now, with silver trading at $59, you might assume, India will divest their holdings and realize profits. This is incorrect. In India, silver is not merely a speculative trade, it represents enduring wealth. It is often referred to as the poor man's gold, but it also serves as a critical industrial input for the affluent. The silver that entered India is not returning to the global market. It has been transmuted into jewelry, or has been integrated into the manufacturing processes of electronics factories. It has been removed from the readily available supply. This is the linchpin of the 1.1 billion ounce narrative, that silver did not simply vanish into thin air. It transitioned from less committed holders to more robust investors. The West is now confronting a scarcity, realizing they relinquished their financial insurance to the East at a fraction of its true value. JP Morgan is cognizant of this reality. They meticulously track these capital flows. They observed the 73 million ounces departing in February of 2024. They witnessed thousands of tons being exported throughout 2025. Why do you believe they have ceased their aggressive short-selling activities? Why do you surmise that the price suppression tactics have become ineffective? Because it is impossible to manipulate a market that is devoid of physical metal. One cannot engineer a flash crash when India is positioned to acquire every single price dip. The prominent Indian investors have effectively broken the resolve of the short sellers. Consequently, the West must now incur a significant premium to reacquire any available metal. Thus, we find ourselves on December 9th, 2025, with silver trading at $59. What lies ahead? We are entering a period of vacuum. In the realm of technical analysis, resistance is generated by individuals anticipating selling opportunities. If one acquired silver at $30 5 years prior, they might opt to sell at $30 to recoup their initial investment. This action creates resistance. However, who purchased silver at $65? Who acquired it at $75? Who bought it at $85? The answer is virtually no one. There is no substantial overhead supply of sellers eager to exit their positions. This signifies that from a technical standpoint, the market is clear. This phenomenon is termed a blue sky breakout. When an asset surpasses its all-time high valuation, it enters a phase where the only mechanism to discover sellers is to escalate the price further. We witnessed this with Bitcoin when it breached $20,000. It subsequently surged to $60,000 within months. We observed a similar pattern with Nvidia. Now, it is silver's turn. However, there exists another significant price target, a target directly indicated by the 1.1 billion ounce deficit, $100. Why $100? Is it merely an arbitrary round figure? No. If one adjusts the 1980 high of $50 for inflation, utilizing the government's own manipulated consumer price index figures, That $50 value equates to approximately $170 in today's currency. Therefore, at $59, silver remains historically undervalued. It is still 60% below its inflation-adjusted all-time high. Yet psychologically, $100 acts as a powerful magnet. The vacuum effect operates as follows. Firstly, short sellers must cover their positions. Hedge funds currently holding short positions are compelled to purchase silver to exit their trades, irrespective of the price. Their priority is survival. Secondly, the phenomenon of fear of missing out. The general public, which may have disregarded silver at $25, observes it reaching $60 on the news. They rush to invest. Thirdly, the industrial sector's alarm. This is the most critical factor. When companies like Tesla and Samsung recognize that the 1.1 billion ounce buffer has been depleted, they cease their cautious purchasing and initiate just-in-case acquisitions. They engage in hoarding. Hoarding inherently generates scarcity. Scarcity precipitates escalating prices. Higher prices, in turn, incentivize further hoarding. This creates a self-reinforcing cycle that is detrimental to financial institutions but highly beneficial for holders of physical silver. The disappearance of the 1.1 billion ounces has established the conditions for this market vacuum. And nature abhors a vacuum. Price will inevitably surge to fill it. I anticipate a rapid ascent from $59 to $75 before the conclusion of this year. And $100 is not a long-term target extending to 2030. It is a projected target for 2026. The deficit of 1.1 billion ounces was not an accidental occurrence. It represented a deliberate transfer of wealth. It was a shift from those who lacked patience to those who exercised it, from adherents of paper assets to pragmatists of physical commodities, from the Western financial sphere to the Eastern markets. For 5 years, the available data provided irrefutable evidence. The reports from the Silver Institute were publicly accessible. The vault data from the London Bullion Market Association was available. The import statistics from India were public knowledge. Every individual had the opportunity to perceive the burgeoning deficit. Every individual had the chance to acquire silver at $22, at $25, at $30. However, they heeded the pronouncements of financial news channels and the Council of Banking Institutions. Now the buffer is gone. The price ceiling at $59 has been shattered, and the vacuum is propelling us upward. If you are observing this broadcast and you continue to hold paper representations of silver, such as unallocated accounts, SLV ETFs, or pool-allocated holdings, you are essentially standing within a burning structure, hoping that the fire insurance provider remains solvent. Secure physical metal if you can still locate it, because the 1.1 billion ounces that have vanished will never reappear. And the acquisition of the next billion ounces will invariably incur a significantly higher cost than $59. The anticipated market squeeze is not approaching. It is already underway. I will see you at $100. Subscribe.